You're listening to Money Never Sleeps Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
Greed, for lack of a better word, is good.
You know what I mean?
Money to be made in a place like this.
Money never sleeps, pal.
You're crazy. Don't run when you lose. Don't whine when it hurts.
You know what it takes to sell real estate?
It takes brass.
I've fallen, and I can't get up.
All right, welcome to Money Never Sleeps. This is the show where we talk about anything and everything that impacts the flow of money from around the corner to around the world. I want to thank you for joining us. What we're going to talk about today, and I said this in the last episode as well, that we're going to be focusing on cryptocurrency, digital assets, tokenization, the next layer on the financial rails, the traditional financial rails, because this is the future of finance. I think that to put things into context, and I don't want this to be, well, when you're listening to a podcast, you're learning, right? So, but I don't want it to be a class lesson. But I do want to talk about the history of money, because it gives greater context into where we're going, right? We first started with the barter system thousands of years ago. The problem with that not all barters were equal, right? You would try to trade grain for cattle and so on and so forth, so you had an asymmetric barter and basically that's when a transaction happens where the goods or services that are exchanged, they differ significantly in perceived or actual value. What winds up happening there, you have an uneven exchange because you have no choice. It's not like you can go and tokenize a cow back then or chop it, cut that into pieces. You couldn't do that until after you bought the whole cow, right? So what happened there is that this is what they had. This is what was in place. Commodity currency is what was there. Grain, cattle, corn, and the like. Very hard to transport. It's not transportable. You could transport it locally, right? But if you needed to go at long distances, it would be difficult. But if you had to go from one town to another and you're looking to sell your merchandise, you got a little or barter your merchandise for something you needed. Let's say you were a farmer and you were farming, grain, you would swap that for tools, and maybe the tool guy is swapping for cattle and so on and so forth. But again, a lot of times very uneven exchange. It evolved over time to shells and even copper bars, believe it or not. Bronze bars. The point of the matter is that, again, even in that respect, not easy to transport. Okay. And then it evolved to gold and silver. Some of the original creators of paper money, that started with China and then evolved from there. But that's a story for another day. But it wasn't until the Persian Empire and the Knights Templar did we have true cross-border trade utilizing coins. Basically, this allowed for international trade. The reason being is that the Persian Empire at the time was huge. The Knights Templar, what did you have? You had the church that was all over the place, so you were able to go and create commerce anywhere. So, that was having swift wire transfer without SWIFT, but that's the way it worked. You would be able to go and redeem, something that you had in one place and bring it somewhere else and sell it over there and still get the same money, because the currency, you had a standardized system in place, and that's what made it effective. But even then, it evolved, because having a whole bunch of coins in your pocket and so on and so forth, wasn't really, nobody wanted to have, a whole bag of coins, even though then they would have it. They would have, a whole bag of coins and then, go and, have commerce. But, it had to evolve. And then, then it evolved to paper money. Initially, it was backed by gold. Then, in all the countries, that actually started, the backing by gold started in Switzerland. Okay, it's a fun fact of useless information, but that's a fact. Then it eventually, actually Sweden. Sorry about that. It was Sweden. But then what wound up happening? The paper money eventually got backed by governments. Adhering to the gold standard for a country that kind of tied the hands of the government. Yeah, as I mentioned, I corrected myself. That started in Sweden, but as other governments started doing this, it prevented them from kind of avoiding runaway inflation or easing policy to keep everything even keel. So if your gold supply is spoken for with the paper money you issued, then how can you issue more paper money? You can't. You really can't do that. So that became an issue because how is the government going to settle everything? How do you fund government programs or wars, right? This is what they were doing in Europe, and this is what they're doing throughout time. They were funding wars with this. Basically, they're promissory notes that they're going to go, hey, give me 2 burgers today. I'll pay you next Tuesday. So you need currency to do that. Bretton Woods, that changed everything when it was agreed that the U.S. came off the gold standard, and it agreed that the U.S. dollar would replace gold as a benchmark currency, where all other currencies globally for any country would use in place of gold reserves, and that changed the game. Okay, it allowed countries to actually ease things, although that should be a good thing, right? You would think you can go and stabilize your government and your country and so on and so forth. It brought out what is called moral hazard. Yeah, moral hazard. That's basically governments issuing paper currency at will to fund government-related programs that the elected officials put into place, or maybe they're doing things to line their pockets. I don't know. I'm not privy to that information. That's way above my pay grade. But in the end, it indebts countries, as we've seen time and time again. You have currency that's devalued, and countries that pretty much go bankrupt. Right now, a country that's actually doing all the right things is El Salvador. Believe it or not, they're doing the right things, and they're building that country up in a way that I think other Latin American countries should take notice of and maybe adhere to it. It's really interesting. But think about it. If everyone was honest in government, then it would be a perfect situation. But come on, when a bartender slings into Congress and into the U.S. Congress, and over a few years, all of a sudden, bing, bap, boom, they have a net worth of over $20 million. Yeah, I'd say something's really, really wrong there, and this is where the problems arise. When you have government that continue to offer programs to go and make their people weaker, because at the end of the day, you keep making things easy for people, they're not going to fight for what they need to. So that's why in a capitalist market, that's the best type of market, because it doesn't, I don't care your skin color, your religion, how you look, you're fat, you're skinny, you're this, you're that, you're tall, you're short, whatever it is, there's no boundaries. It's all predicated on the time you put in and what you're going to do, right? So that's what it all comes down to. And look, blockchain solves a lot of this stuff. And with Bitcoin, as a true store of value, that's digital gold, right? That's been proven. And then you have other layer 1 native tokens such as Ethereum, Pico Novus, Solana, XRP, Avalanche. They're providing the layers on top of the current financial rails. These rails have been around for a couple hundred years. So, I think now on this show it is time to look at some companies that are behind all of that, and the layer 1 native tokens that are behind that are going to benefit, and also the types of companies that are going to benefit. But before that, let's talk about the value of tradfi, defi, convergence, because that's where it all comes down. That's what everything comes down to. That. Okay, having that convergence, you're talking about capital efficiency. You have DeFi primitives like automated market makers, staking, tokenized yield curves. That curves friction and capital deployment. Compared to legacy rails, there are a lot of things that happen there for efficient currency, right? Digital currency, digital assets. You have programmable finance, something that you don't have in TradFi. Where on decentralization you can create smart contracts that enable conditional payments. Like if you don't do this, you don't get this. Okay, it allows for escrow, structured products without intermediaries, peer to peer. I can go send you an escrow, and it's not involving a third party. So there's no one has their hands in my pocket nor yours. You pay your gas fees, but that's okay, right? You're in control of what you're doing. Now let's talk about liquidity. With blockchain, with decentralized finance, you have 24/7, 365 liquidity. You have DeFi protocols. They operate continuously, unlike traditional markets that are bound by the banking hours, settlement days, the 5 days a week, all that stuff. It's a different animal. It's a different animal. Even though you have the New York Stock Exchange that's looking at tokenized stocks, and that I'm sure you're going to have the NASDAQ, you're going to have the CME, you have all this stuff going on. It's going to be an interesting convergence, because it is going to converge. All right. Now, global access. This is a key thing. Basically, if you have someone that is in New York and they are performing a transaction with someone in the middle of Africa, typically you need to send them something. Well, you have to go through the Swift wire transfer system, this, that. Even if you use PayPal, whatever it is, that it can take a few days to get to them. All right, so global access, so you're talking about wallet-based onboarding that bypasses geographic and institutional barriers, period, the end. You're talking about democratizing access to these financial tools, and it should be. This is what it should be. Okay, and then, with banks and brokerage firms, compliance is a big thing, and that should be as well. But when you have, zero knowledge KYC and MPC wallets and programmable identity that can allow for compliant DeFi integration with TradFi institutions, is there. And there's going to be more coming out, and it becomes, again, extremely, extremely interesting, where all these things are going to wind up, bringing the best of both worlds to the table. Now, the layer ones, look, they're going to anchor the new financial stack. No question about it. With native tokens gaining utility as collateral, staking assets, or transaction fuel, right? The winners are the layer one blockchains and native tokens, not your meme tokens and all that nonsense. The people that do that, they have to really, really look in the mirror and say, what am I doing? Okay, you're buying a token that's backed by nothing. It serves no purpose, no utility. And, look, I'm sure in a gaming environment, it may have something going on there. However, for you as an investor, come on, man, go and value your money a little more. Value yourself a little more. Okay, if you're going to do anything, get involved with projects that have utility. So, the strategic role in the convergence, it's not gonna be chain related, even though you're gonna have a lot of different chains, right? You have, Bitcoin, again, reserve asset, collateral layer, the digital gold, period, the end. Building on top of it, I think they will build some additional things on top of it. However, I think that if they ever go in and try to change that protocol, I think that that's going to be a big issue, because the way it is perfect for what it is. You don't want to turn a horse into a zebra. Let the blockchain do what it's going to do, what it's been doing, what it's been successful at doing, creating that value. Ethereum, that has been through a couple of iterations of evolution, with the smart contracts for DeFi. They have stable coins on there, real world assets and that type of thing. Okay, and that becomes a value. And then other blockchains like Pico Novus. You have enterprise grade staking. You have escrow. You have other things that are going on there, as well as smart contracts. But you have stable coins. You have other things going on there. Solana, same thing. And again, with Solana Pico Novus, you have high speed execution, which is good for tokenized assets and consumer DeFi. All right, then you got Ripple. Look, XRP. Ripple. XRP is the token. Ripple is the company. So if you're talking about the token, the utility is there for those that are going to build on it. Ripple has built on it. But anyway, you have cross-border liquidity, stable coin, settlement layer, and blah blah blah. Okay, Avalanche, again, subnet architecture for institutional DeFi and tokenization. Okay, the way they do things is a little bit different than other chains, but there's value there. Okay, you're going to have an evolution also in exchange. All right, you have decentralized exchanges. They benefit from tokenized tradfi assets. They do. Okay, you have real world assets, stable coins, tokenized bonds. Basically all this stuff deepens liquidity. So you're not reinventing the wheel. You're tokenizing things, and you're making it, on a peer-to-peer basis, and that decentralization, it becomes a big punch in the arm moving forward. Okay, you have institutional routing, you got the DEXs that have the ability to go and integrate some sort of zero knowledge based KYC. They become in line to have like regulated swaps and escrow and stuff like that. So you can have some form, I guess, of some centralized aspects to that, which would be interesting. That would also be a hybrid, I guess, but I don't want to get too much into that because, that can start opening up. We'll start going down a rabbit hole that we'll never get out of. But, you have yield aggregation. DEXs, they allow you to do that. You can integrate staking, lending, structured yield products, so on and so forth. And basically the peer-to-peer aspect of that kind of puts you in place that you're in control. You're in control of your wallet. You're in control of your assets, not anyone else. No one can touch it. No one can do anything. You're in control of it. There's nothing better than that. All right. But again, having that, you kind of have to give up something for that, and that may be liquidity, kind of offboarding to fiat and so on and so forth. So you have to take that into consideration as well. Centralized exchanges, they have their structure is more along the lines of TradFi, so they become a hybrid gateway, right? Because they can provide custody and DeFi access, plus compliance for onboarding and so on and so forth. So that's when the regulated that's when the regulators and the regulated markets come into play, because you need that. You have a company that is actually they're providing trading on a centralized trading, right, where you don't actually control your keys. So not your keys, not your crypto. So you have to trust the exchange that actually holds that. So the stablecoin rails, they become interesting because centralized exchanges, they can facilitate fiat to stablecoin conversions and cross-chain liquidity. They can come up with some really cool things that allow people to have access on a global scale. I think that you're going to have centralized exchanges and companies that are in that space. You're going to have M&A targets, no question. You're going to have M&A going on there. You're going to have, traditional, brokerage firms and banks. They're going to go and they're going to be, not the big guys, but you have other ones that provide infrastructure. I see them being acquired by, centralized players and even decentralized players. Now, why wouldn't it be the other way around? That these traditional platforms, these TradFi organizations would acquire the tech companies that do this, Well, they have in some cases, but I think now, people, you have people waking up that are saying, wait a second, the value, the big value is in the future, not in the past. That's what it's coming down to. So that convergence is going to come in hand. Is going to come in very handy with the growth of the digital asset space. So, but when you were talking about payment systems and stable coins, that adoption is going to continue to grow. We've seen it. We've seen it with Tether and USDT. We've seen it with Circle and the USDC. They're the dominant players in the space for retail and institutional flows. But they're not the only players in town. You have Ripple. They came around. You have USXM, and that's on the Pico Nova's blockchain. And that's there. So that stable coin adoption is going to continue to increase. You have banks that are starting to do this. That's not to issue their own. The thing about it is that when a bank does that, there has to be some sort of interoperability with other stable coins so you can provide that, right? You can provide it. If you are XYZ Bank and you have a stable coin and now someone can go and easily transfer that token to someone else and it settles within a minute or 30 seconds, whatever the case may be, the question is, what do they do then? How are they going and going to utilize that outside of the bank? Let's say they wanted to go and use their debit card for something. How does that work? Or they want to go take cash at the bank. So they have to kind of figure that stuff out, which they're going to do it. So now the winners in this space, you have a few winners beyond the exchanges. You have payment systems, payment portals, fintechs that are embracing stablecoin rails, Stripe, PayPal, Revolut. They're going to gain more. They're going to gain more growth. I mean, you're talking about speed and global reach is ridiculous. So that's going to be something big. The groups that the groups that have these payment portals, they're going to start gaining more, and I believe this is going to happen as we go into 2026. The banks that are integrating stablecoin APIs, they're doing that for treasury, payroll, FX settlement. They're going to be winners. They're going to be winners because now they're a part of a bigger ecosystem. Now, the one thing that I don't see happening, because this is when I get concerned, when you have a central bank digital currency. That is bad. They're doing that in China, and basically they control the citizens by doing that. So you have to be in your best behavior. Dystopian environment starts coming to mind. When you think about the government having that much control, to know every dime you have, where it's going, how it's being used, and if you go and you do something bad that may offend the government or offend someone, that they can go and block your access to your own finances. That is never a good thing. Never a good thing, people. Okay. I think we're going to see, an M&A surge in financial infrastructure, as I said earlier. You're going to have tech-driven, firms. They're going to, acquire legacy financial institutions. I have no doubt about it. For licenses, customer bases, regulatory access is happening now, and it's going to continue to happen. All right, traditional banks that if they go and acquire DeFi infrastructure or layer one integrations, they do that to stay competitive, because if they don't do that, they're going to need to do that, no question. If not, they're going to die in the vine. They're going to be the Blockbusters, the Woolworths. They're going to be those type of players. They're going to have, ivy, growing on their walls and then one location left. Now, cross-sector M&A action, very possible. I see that as something that's viable. Exchanges, payment processors, data providers. You can have a convergence and some sort of unified financial platform. That can be interesting, and I do think that that's going to wind up happening. I would prefer it happening with a growth company than with J.P. Morgan, right? Because you don't want any one entity to have too much control, and they have a lot of control, too much control, right? The future of finance is here. Okay, the future of finance is here, and this is why I'm sticking on this topic for the foreseeable future. Because at the end of the day, the more you know, the more you can prepare for what is going to happen. All right, when you have tradfi institutions, when they start to deploy programmable assets on public blockchains, even on private blockchains, that is good for society, I think. Okay, you're going to have tokenized balance sheets. Believe it or not, equity, debt, and cash flow, they're going to be represented on chain. Again, doesn't need to be a public blockchain. It can be a private blockchain that is for the institution itself. But still, you're talking about immutable data. That's truth. That's honesty. Okay, when you're talking about validator economies, this has to do with your layer ones and everything, and it can go beyond that. Look, but let's talk about the layer ones. That validator economy, native tokens, they're going to accrue in value via staking, governance, and transaction routing, and so on and so forth. And you're going to continue to see that. This is why you'll have, and I'll just throw some predictions out there only because, hey, you know what? We're here, right? You're going to have probably Bitcoin. They say 200,000. I think at some point in time it'll be 500,000, 1 million, because you have a limited supply. So as they hit the supply numbers, and you have companies like MicroStrategy or Strategy, and you have Goldman Sachs and BlackRock and so on and so forth, and Galaxy Digital, they're all hoarding Bitcoin, supply and demand. But you're also going to see, something, explosive happen with Ethereum, I believe. I think that token, will be in the $10,000-$20,000 range at some point, if not more. Solana, you probably see that in the $1,000 to $2,000 range at some point. Okay, I'm not going to go into Litecoin and stuff because that's just, that's like a break off of Bitcoin. So where that's going to go, I can't say. I can't even give an opinion on that. But you have, again, like other blockchains, like Avalanche, AVAX, that can be a couple $100 number. You have even look with Piku, that can be a few $100 number, or if not $1,000 number in the future. So you have a lot of value that's there, especially as the building and the financial products are built on these blockchains. This is where everything's going to get very interesting and very quickly. So if I had to give anyone any advice out there, do your research, learn about the space, and the thing about it, you don't need to be a super nerdy, technician and, oh my God, I have to code this. You don't need to do anything. Just learn how it works, the mechanics of it. It's not that difficult. Once you learn it and you see the possibilities, then your eyes open. Then you understand what the future of finance looks like. All right. So now I want to thank you guys for tuning in and kind of, basically absorbing, everything that I laid out today. And I did that for your benefit so you can understand more on how TradFi and DeFi, that convergence, is going to become very important. And I think more people should know this. I don't care where you are in the world. More people should know it. If I can do this show in multiple languages, I would, but I can't. I'm stuck with English. Sorry. But anyway, I want to thank you guys for tuning in, and we'll be back with you on the next episode of Money Never Sleeps. And again, as I said, I'm going to try to bring some guests on to go talk about blockchain, experts in the space, people that have insight that can probably give you further insight. All right, until then, I want you guys to have a great trading day. Hopefully it's profitable, and we'll be back with you next time.
Initiating shutdown sequence.
You're listening to UCW Radio. In your face.
What is your major malfunction?
So let it be written. So let it be done.
Ladies and gentlemen, my mother thanks you, my father thanks you, my sister thanks you, and I thank you.
The views and opinions expressed on Money Never Sleeps Radio are for informational purposes only and should not be construed as financial advice. The host Louis Velazquez and guests of Money Never Sleeps Radio are not licensed financial advisors, and any investment decisions made based on information presented in this podcast are at the listener's own risk. Listeners are encouraged to consult with a qualified financial advisor or investment professional before making any investment decisions. The podcast hosts and guests do not endorse or recommend any specific investment strategies or products. All investments involve risk, and past performance is not indicative of future results.